Welcome back to the Deep Dive. This is where we take these, massive piles of research and try to turn them into actionable, unforgettable knowledge.
And today, the subject is, truly fascinating.
It really is. We are analyzing the playbook of one of the most successful private investors out there, a man known online as NemcapSe.
Or Christian, his real name.
Yeah.
And the numbers, they're just staggering. We're talking about a career spanning 2 decades.
Okay, so get this. He starts with just 168,000 Swedish krona.
Which is not a huge amount of money.
No. And he grows that into a portfolio that's now valued at around 500 million SEK.
The math on that is just mind-blowing. It's a cumulative return of, what, over 21,000%?
21,716.50%. That works out to a CAGR, a compound annual growth rate, of 63.10% every single year. For 20 years.
Which is just, it's world-class. It's almost unbelievable, and that's really the centerpiece of this whole deep dive.
Exactly. So our mission today is to get past those crazy numbers. We want to extract his core philosophy, the actual strategies he talks about on his blog.
And we really want to focus on what makes his approach so relevant for you, the investor working with smaller capital, because that's where he says the real structural advantages are.
Yeah. All right, so let's get into it. Before he was this investing legend, he was, and he admits this himself, a pretty reckless learner.
Oh, yeah. His early career, starting back in around 2003, was pure chaos. He said he owned a myriad of companies and had grotesque turnover.
So just buying and selling constantly.
Constantly. And it was a classic case of early luck, masking a lack of any real structure. He had his single best year ever during this phase.
That was a 300% gain, right?
A massive 300% gain, yeah. It was driven by one really aggressive bet on a gaming company called Betsson. He was trigger happy, and that one time he won big.
But the market always teaches you a lesson.
And it delivered a painful one. His very next big bet led to a 70% portfolio loss.
70%, wow.
Over the next 2 years, it completely wiped out all that early momentum. His CAGR for that entire roller coaster period was basically 0.
So all that stress, all that volatility for nothing.
Exactly. And that's the moment of clarity we really need to focus on. He looked at this 7-year period of just, wild swings and 0 net return, and he realized something.
What was that?
That his early success had nothing to do with skill. He felt his knowledge only became, in his words, sufficient. So rigorous and consistent around 2010 or 2011.
So it was a 7-year apprenticeship in humility, basically.
Yep.
What did he decide was the real bottleneck then? The thing holding him back?
It wasn't intellect. This is so important. He strongly believes the real edge in investing is not having a super high IQ.
He quotes Charlie Munger on that, right?
Yeah, that it's better to have a 130 IQ and think it's 120. The real key is eliminating the mistakes caused by your own psychological urges.
Greed, fear, impatience, all that stuff.
All of it. This shift is it's profound. It means success has more to do with your temperament than your financial modeling skills. It's about patience. It's about being able to choose your shots.
And not acting on every impulse.
Precisely. His core learning from what he calls his old sins, those early mistakes, is that your future returns depend entirely on learning to manage those urges. He found that making fewer and fewer transactions consistently led to higher returns.
So you have to survive the mistakes, but then you actually have to learn from them and stop making them.
That's the foundation.
Okay, so this focus on deep knowledge and superior temperament, it leads directly to his most controversial idea, extreme concentration.
It does. He says that for an active investor, owning a position that's less than 5% of your portfolio is just, quote, wrong.
Wrong. Why?
His reasoning is that you hardly get paid for being active. He's making a really crucial point about efficiency here.
Okay, explain that.
Well, think about it. Why would you spend 40 hours researching and monitoring a company?
Right, doing all that deep work.
If you only end up allocating 2% of your capital to it, the mental effort, the opportunity cost, it's just too high for such a tiny reward.
That makes sense. So his portfolio reflects that. He's often had 20, even 30% in a single company.
Historically, yes. Highly concentrated.
Okay, I have to push back on this a little. I mean, the returns are incredible, but telling the average person to put 30% of their money in one stock? Isn't that shifting from investing into just pure speculation?
That's the million-dollar question, and it comes down to process. Speculation is a big bet based on hope. NemcapSe's big bet is based on a deeply researched, independent conviction.
A conviction he's earned through all that work.
Yes. He feels that once you have about 6 to 8 stocks, you've achieved sufficient diversification. He has this great little formula for it.
What's that?
Diversification equals 1 divided by confidence.
Huh. So if your confidence is extremely high, your need for diversification plummets.
Exactly. It's an inverse relationship.
So if you're going to bet that big, your criteria for what makes a good investment must be, like, ironclad. What are his non-negotiables?
He has 4 things that must align. First, a low valuation. Second, strong growth, but specifically with increasing profitability. So scalability, margin expansion.
Got it. What's third?
Third, the company has to be undiscovered or, unloved by the wider market. And fourth, management has to have significant ownership, skin in the game.
And the final piece, the rare ingredient that ties it all together, is what he calls superior capital allocation.
Yes, a concept he really learned from studying managers in books like The Outsiders. It's the secret sauce.
So how does he apply that in the real world?
His investment in a company called Cherry is the perfect case study. Cherry created, enormous values by acquiring smaller, less expensive companies and just rapidly growing them.
Like who?
Well, they acquired Yggdrasil Gaming, which went from making less than 3 million SEK in early 2015 to 71 million SEK a quarter just 3 years later.
Wow. That's explosive growth.
It is. And they also bought a company called Game Lounge for, quote, almost nothing. That company now earns over 120 million SEK in EBITDA every year.
That's just phenomenal value creation, driven by smart management moves.
Exactly. And this is what allows him to justify paying what might look like a high price at first. You might buy a great company at a PE ratio of 21 and the market screams, that's expensive.
Right.
But if that management team are brilliant capital allocators, they use their cash flow to make these smart acquisitions, literally growing the earnings faster than the price. They pull that valuation down so fast that your effective PE drops from 21 to maybe 6 or 8 in just a few years.
That's the power of great management executing on a growth plan.
It's everything.
Okay, but finding management with that kind of skill is rare. But here's where it gets really, really interesting for our listener. NemcapSe argues that finding these diamonds is actually easier for you.
It all comes down to a single factor, size. He loves to quote Warren Buffett on this.
What's the quote?
Anyone who says that size does not hurt investment performance is selling. I think I could make you 50% a year on $1 million. No, I know I could. I guarantee that.
So not having billions of dollars is actually a structural advantage. Why?
Because you can exploit what he calls pockets of inefficiencies. With smaller capital, you can focus on the absolute smallest companies. We're talking market caps between, say, 50 million and 5 billion SEK.
And what's special about that space?
These companies, they often have no institutional ownership. They're covered by maybe 1 or 2 analysts, if any. The information flow is limited. This creates the biggest possible gap between the public price and the true intrinsic value.
And the big funds that just can't invest there. They'd buy the whole company by accident.
They'd move the price too much. They can't get in or out. So the opportunity is there, but it demands that knowledge and confidence we talked about.
Right. So what's the price of admission? What does NemcapSe demand from an investor who wants to get these kinds of returns?
The price is time and effort. He's very clear. You must spend plus 15 hours a week for several years and read more than 1 new book per month for the next 5 years.
That's a serious commitment.
It is. You need that deep knowledge of accounting, of moats, of valuation to develop what he calls independent thinking. That's what lets you act when everyone else is frozen in panic.
And he has some very clear thoughts on market timing, too.
Oh, yeah. He thinks trying to predict the market based on macro stuff like Brexit or interest rates is, quote, pointless.
So just focus on the individual business.
Exactly. And that affects your cash position. If you have smaller capital and you found these great ideas that meet his 4 criteria, you should be fully invested.
No sitting on the sidelines.
No. Cash is only an option to buy cheaper later if the whole market is so expensive that you're only expecting, say, 5 or 10% returns from your current holdings.
The Leo Vegas case he talks about is a perfect example of the temperament you need for this.
It really is. The stock fell, from an all-time high of 110, just cratered.
And why? It was insider selling, new UK regulations. The sentiment was just awful. The fear was real.
Total panic. And that panic, driven by temporary regulatory confusion and some insider sales, created a massive value opportunity. The key question NemcapSe says you have to ask is this.
Okay.
Does this new information permanently damage the company's durable competitive advantage, its ability to make higher returns on its capital?
So is the business model fundamentally broken?
Right. And if the answer is no, if the core business is still intact, then that falling stock price is just a gift. It's cheap alpha, but you can only grab it if you have the guts to buy when everyone else is selling.
So this whole deep dive, it really shows that Nemcap's performance, it's not about luck. It's a two-part equation.
It really is. You need the rigorous knowledge understanding, valuation, moats, all of that. But you also need the superior temperament to act rationally when the market is irrational.
When everyone is driven by fear and greed.
That emotional control is paramount, especially when you're concentrating your portfolio. If you're a small investor, every single decision has to be made with just brutal objectivity.
And that brings us to the final provocative thought we want to leave you with. NemCap said the idea of holding, say, 20 or 30% of your portfolio in cash just to buy a 10% dip.
He called it absurd.
Absurd. Why?
Because if you have a great undervalued company that you know inside and out and you're just sitting on that cash, that idle money is missing out on a much larger compounding return over time.
So you're trying to avoid a small potential loss.
But in doing so, you are guaranteeing that you miss out on a massive probable gain. That money left on the table, the opportunity cost, that's the real silent killer of your long-term performance.
And that's the metric you should be focusing on. So if you want to build that knowledge base to get the confidence to go all in.
Start where he did. He recommends Phil Fisher, Seth Klarman, The Outsiders. Those are really excellent starting points for your own deep dive.